right, good afternoon. It is a pleasure to be here, and I think I have a tough act to follow after this wonderful panel discussion that we just heard. But I think I do have an opportunity to create a few connections from what we've just heard with our topic here is about creating a strong Istanbul brand, not only in a vacuum, but also specifically for the information age that we heard so much about today. So here's what I would like to go in the brief time that we have together. I'd like to first step back at a very qualitative level, do something very simple to sort of define what's a strong brand. I'm not sure that we have done that yet. We have, of course, given many, many examples. The second thing I'd like to do is to give a quick overview about why do we do branding in the first place, because it requires effort. Most companies actually don't have strong brands. A strong brand is an exception rather than a rule, and it can be expensive. So therefore, we need to learn something about financial impact of strong brands in order to make that worth our while. Third thing I'll do is I'll take that branding concept into the information age. We've already heard a great deal about it this morning, and that's the reality. We cannot assume that the principles by which you become a strong brand in the 21st century will be the same as in the 20th or the 19th century. So we'll review that. And then finally, I'll make some implications for our key topic about Istanbul as a strong brand. So that's the 4 points I would like to cover with you. So let's start. Well, it's quite obvious that to create awareness is key in starting a branding strategy. People have to know your name. So once in a while I watch some tennis, and a couple of months ago I saw Roger Federer play. And you know him well, is probably the world's most famous tennis player. But what surprised me is he was not wearing a Nike outfit. He was wearing basically the signals and the logo of another brand. Okay? And that brand is Japanese. And I actually would have had a complete lack of knowledge about the existence of that brand if it wasn't for Roger Federer. So awareness creation is key, but it's only the first thing. It is not sufficient, okay? Which gets then to the next question is, well, what is there beyond awareness, okay? And here we go to some research about brand personality that is really very interesting and I think can apply very, very well to our discussion here today. See, there's been some research done that sort of disentangles the sources of personality, okay, and as applied to brands. And here they are. There are many aspects of personality, but you can summarize them along the following five dimensions: sincerity, excitement, competence, sophistication, and ruggedness. Okay? And I'm really drawing from the scientific literature here. I didn't make these up. Okay? There's a lot of strong empirical support for this. So let's take a look at this. The issue is that not all brands are going to score high on all dimensions. And this is also going to be a function of perhaps what industry you're in, which may care more about one dimension than another. So, for example, let me take the Beko example from the previous panel discussion. And you heard our speakers say that at one point in the evolution of Beko, they decided to sponsor some sports teams, and several of them, including Barcelona Football Club. Okay? That creates awareness. That's great. But let's see what else it does. Okay? Let's contrast what Beko does, you know, appliances and consumer electronics, and let's see what FC Barcelona does, okay? If you're in the appliance business, yeah, you can build high-quality product which creates competence. These products can be rugged, okay? They can be sophisticated with electronic devices, but it's hard to call an appliance exciting. It's not exciting. The category is not exciting. But a soccer team, especially FC Barcelona, that's exciting. Sports is exciting. So from a personality fit perspective, what they're doing is they're taking 4 dimensions that they're sort of good at by virtue of the business they're in. They see what's lacking in the personality profile, and then they sponsor sports teams. And that brings excitement into a category which is otherwise very difficult to create excitement for. Okay? So you see from a strategic perspective, their strategy is actually beautifully aligned with the notion of creating personality for a brand, that is to create the key associations. This is a word that I've heard, of course, before, but it really is key. A brand is basically a set of associations between the provider of the product or service and its origin. Okay, that's what a brand is. Okay. All right. So a little bit about financial impact. Again, we've heard a few things about this already, but it's important actually to drive the point home on this. What do you get out of strong brands? The scientific literature in marketing shows that all else equal, you create higher demand. So that's good. You create higher sales, and so it helps you achieve your growth objectives. That's pretty straightforward. But it does more than that. Okay? There is generally a strong association between the quality, or excuse me, between the strength of the brand and the price premium that it can charge. And again, we saw an example of that in the previous panel discussion. Okay? That price premium in the US averages 26%. Okay? So if you take a category, pick any category, and you look at strong brands and weak brands, or weaker brands, there tends to be a 26% price premium, even though the products are otherwise very similar. Okay? That is not to be underestimated because, of course, you get much more revenue for the same amount of sales. Okay? A third one is the opportunity to expand. For example, to go into international markets if you already have a strong brand, but also, for example, to get into adjacent product categories and to expand your distribution. And that is because as a representative for a strong brand, a salesperson usually finds it easier to get access to new distribution points than a weaker brand. Okay, we see that very, very strongly. Okay? And finally, and this one is sometimes underestimated, but strong brands have lower sales volatility. And now you have to think about the economic environment. See, we all hope to be doing better and better in business, but we're subject to the economic swings. And in some sectors, of course, it's stronger than others, okay? It's been shown that strong brands kind of weather the storm of an economic recession better than weak brands, okay? So the volatility, there's still some volatility, but it's smaller than with weaker brands, all else equal. Going back to the major recession we had starting in 2007, then into 2008, 2009, we certainly saw some of the weaker brands actually cull their product portfolio. So in other words, chopping off sub-brands, whereas the weaker brands didn't have to, the stronger brands didn't have to do that, okay? You also saw it in the evolution of their valuations, okay? So these are just on the financial side, some demonstrated advantages of strong brands. And then in addition, of course, you have what's already been mentioned, the effect on personnel, attracting higher quality people, being able to retain them longer, also access to capital markets, venture capital, brand funding, that sort of thing. Those all have been demonstrated. I'll give you an example of something I read about just yesterday that I was not aware of, and it relates also this morning to Professor Kotler's introduction around having a mission and a sense of social responsibility in our companies. I've just read that a lot of young people in the US, young engineers, young MBAs, etc., they really like the idea of working for Tesla. Okay. Now, Tesla is just a car company, but then again, it isn't. It only makes electric cars. And so there comes this notion of, well, you know, if I'm going to work for a car company, let me work for a company that promotes totally pollution-free products and is the wave of the future. Even though when you actually join that company, it's incredibly hard work because they are ramping up production as fast as they can, and so consequently the work conditions are very, very taxing. But there is a sense of accomplishment when you work for a company with those kinds of objectives relative to a more legacy company. Okay, now, that's all good. Those are perhaps, I hope, reasonings that makes logical sense to you. But now the question is, do we actually see that in the data? Or is this just wishful thinking? Well, some colleagues of mine, I mentioned them there a couple of years ago, did a very interesting study about the relationship between the value of the brand and the value of the firm, you know, the stock returns that a company has. And this is, of course, for public companies. Okay? The elasticity, I'll explain in a second, is 0.33, the average. Okay? So here's what that means. For every 10% increase in brand strength, the value of the company goes up by 3.3%. Okay? So, and that is, and you know that these brand valuations, those are net present values of future earnings. That's what a stock price really is. And so you see right there that the investor community implicitly appreciates strong brands because they believe that they are in a better position for the future. So you see that confirmed in the data. And I will come back to that in a minute. I also mentioned another result, very strong result, on the practice of either corporate branding or house of brands. Let me explain. If all of your products have the same name, you are a corporate brand, like Disney, for example, or Facebook, etc. Okay? If, however, the corporate brand is much less well known, but the individual sub-brands, the products, are very well known, then you have a house of brands. That's Procter & Gamble, which has been mentioned. Okay? Not many people know that, for example, Tide, which was shown earlier in a slide, is a Procter & Gamble brand. The company stresses the product name or the product brand name, such as Tide, but doesn't really stress the corporation too much. Okay? And there's reasons for doing either. Okay? So the research shows that the financial returns of corporate brands, all else equal, are higher than those for house of brands. So in other words, there is a lift of branding the entire corporation that you otherwise forsake if you opt for a house of brand strategy. So for these reasons, those are just two examples of how we can say that there is strong evidence, scientific evidence, that branding, even though it's hard work, it can take a long time, and it can be costly, that it provides superior financial returns across the board. Okay, so now we get into the question about what's changing in the information age. And you remember from the discussions this morning, you already got a preview, there is a great deal of change. And my objective here is not to review all the tech developments, but rather to study a little bit what happens to the consumer and his or her attitude towards brands when you see so much technological innovation happening, whether it's AI or mobile marketing or any of a large number of digital initiatives that we have seen and that we continue to see. So here's my overall perspective is as follows, and we have to be very careful here, okay? The key thing as I see it, what's happening for consumers, is that product information is easier to obtain. Simple as that. So people have always wanted high-quality products to buy at a fair price. That's the same as before. But what's changed is the cost of obtaining information about product quality has gone way down. Why? Because the digital age provides a wealth of data points for you to look at when making a product or a service choice. Okay? And because that is going down, the feedback loop from customer satisfaction is becoming stronger. Okay? So, make the following comparison. You are traveling to a city where you have not been before. You're walking through the streets of the city, and you need a place to stay. And you see hotels, or you need a place to eat. You see names of restaurants. You don't know anything about them. And then you see a well-known name, maybe a Hilton hotel or something. You say, oh, that's a big brand, I'll go there. That must be good. Okay? Now, there's nothing wrong with that, but you're just reacting to the presence of a quality signal, which is just the name of a brand that you're familiar with. And what's changing now in the information age, that it is so easy to get your smartphone out and to take a quick look at the reviews, not necessarily of the brand, but the particular property that you're looking at, okay? Because you could have the Hilton brand, and then there is one on this street, and there is one the other side of town, and their qualities are different. You would find that from access to modern information sources, for example, your smartphone, okay? And we see that everywhere. The fact that the cost of obtaining quality information is going down, that is what's changing people's behavior in a direction of being more product-focused, and therefore being satisfied with the product becomes a key ingredient for future purchases and for positive word of mouth. Okay. So, again, that's an idea, a principle that I hope you agree with, but let's see if that this is actually true by looking at the real world. So I have a couple of data points on that. The first one is a colleague of mine at the University of Michigan, Klaas Fornell, and he has worked for many years with something known as the American Consumer Satisfaction Index. So he just simply surveys people, lots of them, ongoing, about their satisfaction with various products under different brand names across industries. It's a huge enterprise, by the way. And I think 4 times a year he publishes the results. Okay, so now you see that, for example, in the computer world, Hewlett-Packard is up and Dell is down, and in customer satisfaction. And in the automotive world, Volkswagen is up and Citroën is down, whatever. Okay? Well, these data are public. They're public information. You can actually take a look and see how these companies are doing in the stock market as a function of those customer satisfaction indices. So he built a little index fund on that, a hedge fund. It has the simplest rule ever, okay? If the satisfaction index goes up, buy. If the satisfaction index goes down, sell. You know, you can program that into a computer very easily, okay? And so he creates a portfolio and follows an investment portfolio and follows it for 15 years. So this is not a sample of 3 months or something. This is 15 years, including the big recession of 07-08. It's in there, okay? So then he compares that to having a portfolio, like many of us have, of just the stock market indicator. And the largest one in the US is called the S&P 500, so it has 500 firms in it, okay? If you had invested in the S&P 500 over a 15-year period, your return would have been about 31%. It's actually not very high, but that's because the S&P took a big dip in 2008 and then went back up. But if you had taken that hedge fund with just looking at customer satisfaction, ignore everything else, your cumulative return would have been 518%. Okay. So that is a huge endorsement based on real objective data of the notion that customer satisfaction is driving people's purchase behavior, and of course, people's purchase behavior is then reflected in either good or not so good financial results, etc., etc. Okay, so one data point. Okay. A second data point is from the same study that I mentioned 5 minutes ago, where we take a look at not only the effect of brand assets on the stock value, but also customer assets, like customer loyalty, customer satisfaction. And there are these elasticities. Okay? You've already seen the one for brand, it's 0.33. But now I'm comparing it to the one on customer assets, and it is 0.72. Okay? So we need to think through what that means. So first of all, brand is still very, very important. A 0.33 elasticity is very strong. But that customer aspect has gotten even stronger. Okay? And that is different from what it would indicate the case, let's say 20, 30 years ago, when we did not have easy access to information, so therefore consumers were more reliant on brand than they are today. Okay? So the new branding strategy, if you wish, that works is not only create awareness and associations, but once you've done that, you've got to deliver. And you've got to get that customer satisfaction level high. And under those conditions, you get a combined effect that really can produce enormous results. Okay? Let me just, Amazon, for example, for many years was having huge losses until a sufficient number of repeat purchases kicked in. That's customer satisfaction plus brand value, and it's started to grow exponentially in revenues, and it's now very, very profitable. Okay? So those are examples that show that in the information age, the reality is a little different from what it was, and we'll talk about implications for Istanbul in just a minute. And my final example is a young colleague of mine at UCLA who also he also looked at hotel data, and what he's seeing is that if he looks through a whole bunch of financial records and he compares hotels that are very profitable versus less profitable, and he does that 10 years ago, it's mostly brand strength that drives the results. Okay? And then over time, the brand strength is still important, but gradually the importance of one particular hotel of the chain gains in importance. Okay? So the brand influence goes down and the product influence goes up. Okay? And again, that doesn't mean that brand is not important. It means that circumstances have changed where customers can now have more of that product information and are acting accordingly. Okay? We also saw that, by the way, some work that I did a couple of years ago, when you take a look at when firms are sold, mergers or acquisitions. When there's a merger or an acquisition, the accountants, the specialist accountants, actually break down the purchase price into the value of the brand and the value of the customer value, of the customer base. And then, of course, other things. Okay? And so again, over time, between 2003 and 2013, you see that brand value has gone down and customer value has gone up. Okay? The sum of the two is still about the same, but the relative ratio of each is changing. And I have to say that at least in the US, just the last 2-3 years, I'm starting to see more reaction in industry on that. More focus on, for example, what is the lifetime value of a customer? Well, how do you create lifetime value of a customer? A, by acquisition, and brand is very important there, and B, by retention. But retention is much more a function of customer satisfaction than it is of brand affiliation. So that's how the two work together in terms of creating value in the current market environment. Okay, so what are the implications for our topic today of the global brand value of Istanbul or the companies that operate here? The first one is, Istanbul needs a brand personality. It has a rich history. It has an amazing location. It is where East meets West. It has the wonderful attributes that we have already talked about. Okay? But how does that connect to the personality dimensions that I mentioned in my first slide? Okay? I've not been able to research that, and I hope that the Chamber of Commerce, who's obviously and for good reasons behind this effort, takes a look at that and see what are really the dimensions of personality where Istanbul excels, and where are the dimensions, because you can't excel on everything, where Istanbul is maybe average and needs some help from other sources. Okay? So that is a first area of implication, I would say. The second one is the importance of brand consistency. Once you have a brand, you have to be consistent with the brand message. I'll give you two counter-examples. I'm pretty sure you know the French brand of sparkling water, Perrier. It's been around for a long time. It's a strong brand. Perrier is successful in the United States, but sometime in the 1990s, I forgot exactly when, there was a problem with a filter in the factory, and this is well water, okay? And they found traces of benzene in the product. Now, it was not poisonous, but it was sufficiently alarming that the Food and Drug Administration in the US ordered, okay, you have to fix this problem, and you have to pull all of the products off the shelf. Okay, so the brand was removed from the shelves in all American stores for 4 months. That's 4 months, that's it. 4 months later, the problem was fixed, the product was back, okay? 3 years later, the brand had only achieved half of its sales that it had prior to the removal, okay? So what had happened, okay? You had a successful brand that suddenly is taken away from the market only for 4 months, and you have a healthy competitive system, and meanwhile other brands had jumped in, and then when the brand comes back, it did okay, but only half as good as what it was before the removal. Okay? So that shows that the consistency is, in this case, consistency of availability of the product is important. Okay? The second example is one I was reminded when Professor Kotler in the earlier session picked one country as an example. He picked Belgium. Now, it turns out, even though I teach in California, I am actually from Belgium originally. So I got a little bit worried. I said, what is he going to say about Belgium? Okay. And of course, he said, as most people would say, that it's very hard to point to things that we all know about Belgium. He did get it right. We do have a king. Okay, so we got that right. Okay. But what's one of the problems with Belgium? It's these multiple language groups. There's 2 of them, and then Brussels wants to be sort of its own country, more or less. So what happens is, from a government perspective, there is a Belgian government, then there is a Flemish government, then there is a Walloon government, and then there's a Brussels government. And they all try to attract, for example, investors or locations of foreign subsidiaries. So what happens if you're, let's say, American or Turkish or Brazilian, you get very confused. Now, wait a minute, this is Belgium, but this is Flemish. But I talked to the consul from Belgium yesterday, and you represent the Flemish government? What's the difference? They don't understand. I understand, I'm from there, okay? But you cannot expect people to understand complexity when the complexity is not really needed. So there's a lack of consistency of message in that country that creates a weakness in branding, and that's one of the reasons why Belgium doesn't have a strong brand, is the messaging is inconsistent. Okay? I would have to say, from what I've heard so far here, the message here is very consistent. You know, it is about Istanbul. Okay? And that's clear and well-known and has a lot of historical significance. Okay? It will only need, as I said, the brand fit in different categories. Is it about technology? Is it about design? Is it about taste? Is it about history? How does that translate into opinions about the Istanbul brand in today's environment in a way that's relevant for consumers? And then finally, last but not least, it is the information age. What can you do now very cheaply in the information age that you couldn't do before is monitor. Not necessarily by running expensive surveys, but by monitoring, let's say, click streams or Facebook likes or other metrics of how the brand is sort of evolving over time. That is actually now relatively easy to do. There are various providers of these internet services that show you what people are clicking on in their internet behavior, which actually correlates very highly with their overall interest. And so monitoring is the brand going up in interest levels, or is the brand going down? And if it is going down, of course, take corrective action to try to prevent any further erosion. Okay? So I think I have run out of time here, so what I was hoping to achieve is take the rich lessons that we've learned earlier today, both this morning and this afternoon, put a little bit of structure around it, first in a qualitative way. When we say brand, what does that really mean? It's these associations that I've summarized. Then talk a little bit about what are the financial benefits and what's proof of the benefits. So if anybody is skeptical, you use that as evidence, okay? And then take that material into the information age and discuss what's different between building brands now versus building brands, 100 years ago. I have to say, being from California, we have sort of an advantage here. As you know, a lot of the technology brands are from California, and it's just the opposite of Istanbul. You have history, fantastic history. We don't. Okay. California's history, in as far as it was meaningful for the world, starts at best 150 or 170 years ago, 1849, the gold rush. Okay? When we see a building in California that's 75 years old, we say, wow, a 75-year-old building, take a picture. Okay? But it's our lack of history, in a way, that gives us this flexibility to say, let's try this, let's try that, because we don't have much background to rely upon. Okay? So what's an advantage in one case, in this case, is very, very different from yours. And by the same token, you have tremendous sources of brand connections that can provide a beautiful platform for marketing into the future. And I wish you all the best of luck with that. And with that, I will close. Thank you.